If you have been researching ETFs, you have probably come across two terms that sound confusing at first: accumulating and distributing. They sound technical, but the concept is quite straightforward. Let's break it down. Some companies listed on stock exchanges, when they make profits, they can either reinvest those profits into the same company or share part of them with investors. And when these companies share profits with investors, this payment is called dividend. Now, when you invest through an ETF, some of the companies in the ETF will pay dividends. It is then the ETF has to make a decision on what to do with that income. A distributing ETF pays the dividends out to you as cash, and you will usually see this money land in your investment account half yearly or annually, depending upon the frequency of distribution. An accumulating ETF does the opposite. Instead of paying the dividend out, it automatically reinvests it back into the same ETF on your behalf. You don't see any cash in your account, but your investment quietly grows in the background. So the key difference isn't how much money you will make overall, it's what happens to those dividends along the way. If you're investing for long-term growth, many investors prefer accumulating ETFs because they make compounding simpler. You don't need to reinvest dividends manually, and the returns stay invested on a larger base. Distributing ETFs, on the other hand, are often used by investors who want regular income, such as those in or near retirement. Importantly, if you hold a distributing ETF in a general investment account, not an ISA, dividends can be subject to UK dividend tax. For the current tax year, 2025 to 2026, everyone has £500 dividend allowance, meaning the first £500 would be tax-free. Anything above that could be taxed at rates between 8 to 40%, depending upon your tax band. Dividends received inside a stocks and shares ISA remain completely tax-free, which is one of the biggest reasons many long-term investors prefer using ISAs for dividend-paying investments. Neither accumulating nor distributing ETFs are inherently better. They are just designed for different goals. One important point is that an accumulating and distributing ETF can track the same index. The only difference is how they handle income. I've shared a picture on the screen that shows an example of an index ETF with two variants of accumulating and distributing. Understanding this distinction helps you choose an ETF that actually matches your investing goals. In the next video, I will explain ETF fees and something called replication methods and why they matter more than most people realize.